So welcome to this vlog where we finally go into the discussion stocks or property investing, which makes the better return of investment. And I'm discussing in my circle of friends, in my circle of family. And in my personal opinion, and you will see why, I believe that the stocks are gonna beat the property investment. And to illustrate all of this, I made up a small funny story to go through, so make sure to stay tuned and let's roll.
Wolf of Dubai.
So for the sake of argument, let's go and visit the two twin brothers, Mike and Joe. Mike is more the property type and Joe is the stock type of investor. Now, both, for the sake of argument and easy calculation, have $100,000 cash for investment, which they will invest, and we will follow them on their journey. Then we will see in the end of the journey if and how and why, who made the better return on investment through its investing. So Mike goes out there with his $100,000 and he opens most probably a Zillow.com or any other property finder company and looked for a property that he likes, that he thinks is a good investment and want to buy. Now from this $100,000, obviously there are some costs. Now he will pay approximately 5% broker fee, and this and all of this video is average numbers because there's viewers from United States, from Europe, from Asia, and from Canada, and all the other countries and regions. So this is real average numbers that are really very possible to assume as a general rule of thumb and as calculation purpose. So let's say the first 5% goes for the broker, then he has to pay 5% for taxes. This can also depend, but let's say for the sake of calculation, we take 5% and then 5% fees, which is, let's say, notary fees or other bigger taxes or other fees that is going into a purchase of a real estate. Now, from this, and this is a little bit, let's say, shocking, but actually he cannot invest $100,000, but in his property value goes only $85,000. So he actually needful to look for, even when he has $100,000 in cash, he only can look for properties that are valued around $85,000 because everything else, 15% in total, goes on broker, taxes, and fees. Now, however, let's see how this $85,000 property investment further develops after the first year. So I took an average value increasing number for properties from the 1960s until now worldwide, and I came to an average of 6.5%. So you can assume that your property every year gains on value on average 6.5%. Some regions more, some regions less, some regions have like a spike and then goes down in value, so it's similar to a stock market but less volatile. Now, on the other hand, you also have assumed that he either saved his whole rent because he lives there now, or he actually rented out and gets about 5% of the whole value per year for the property. Now, on the other side, he has to pay 2%, which means for maintenance. Sometimes we have very less maintenance, but some years we have high maintenance. And this 2%, I also assume management fees. Like for some properties, you need to pay for the pool, for the securities, for the concierge services, for some other arrangements. You have to also put aside something for the insurance. So all of this should be covered as yearly cost, 2% for the property. So we come to an all in all gain of 9.5%, which is a new value of the property of $93,075. So this is actually not that he has this on his bank account, but actually can assume approximately the value, deducting by the cost that he had, that what he, actually spent and what is his net worth of this property. And if you're considering this is $6,925 less than his initial investment, and therefore in the first year Mike loses about 7% on his money, because obviously the 15% in the very beginning are very high initial costs when he buys into the property, and then this other gain takes a little bit of time. So next year he breaks even, but we will come later on in the full of calculation on long-term 10 years. So if you like this kind of videos, make sure to smash that like button and also subscribe to this channel, because we are talking daily about stocks and investment. So let's see what Joe is doing with his stock investing. So Joe takes also $100,000 in cash. Nobody asks where he has it. Maybe he has it from his grandma, or he earned it, or he saved it. We don't know, but he, same as his twin brother Mike, has this 100K. Now, for sake of argument, because there's a lot of brokerage out there, and as you know from my yesterday video, if you should check it out, it's a stock market video for beginners. So interesting how to gain every year 10% on average without doing nothing. So actually, if you are knowing what the broker is, you put their money there and invest into a stock market index ETF and leave your money there. So most of these trades are totally without any charges. So that means that if he puts $100,000 into his portfolio, he has $100,000 to buy stocks. So let's assume he bought like an ETF, like I recommended yesterday, which you don't have to do anything, and it's a basket of the best 500 companies in the US, on the US economy, the strongest economy in the world. Now on average, then you are gaining with his value about 10%. Now to this 10% gain, which is on average, like for example last year on the stock market we had 30%, maybe this year we will have 10%, 20%, we don't know, but after a great year usually follows a good year, so we should be fine with that. But on average, also with crisis, with world wars and everything negative, we on average had 10% return on the stock market if you invested in an ETF. Now you can see here the next point that is even in addition to that is 2% dividend. So this is in total 12% that you gain directly on your money in cash. And I put, to be fair, a little bit of trade fees or management fees or whatsoever. If you're investing, for example, in the ETF, it's 0.03%, so $3 on $10,000. So it's basically nothing. But for fairness, if you trade a bit, then I put 0.5%. If you're paying more than that, then definitely don't trade or change the broker. So in the end of the year, he has $111,500 on his account in cash, guys. This is a return of investment of 11.5%. And you see now where I'm going with. Now, compared to the rental property investment, they were -7. We are +11.5. So we are outperforming the rental with more than 18%. So this is ridiculous. In the first year, you are way better as the rental property and have much less work to do. Okay, so and this is actually my main argument, and we come later on to some details. But if you're investing in stocks, you actually just buy it and go sleep for 10 years. So that would be the very best things for you to do. And if we are diving further into the calculations, you will see how it further developed after 10 years, because this is important. Now, if you're buying a property or buying stocks, you always have to think long term, because this yearly up and downs or weekly or daily up and downs just will make you crazy. This is the same as somebody would come every day to your house and would say, hey, your house is valued 2% less today. Do you want to sell or you want to buy? Do you want to sell tomorrow tomorrow it is now today minus 5%. So it would make you crazy, and that's why stocks can be easily psychology a little bit hard on you if you see the stock and look at it every few hours what's the stock is going. So just forget about it like you would buy a property and just don't think about it. Now let's have a look onto the calculation. So as we saw, Mike, who invested $100,000, had a net value of $85,000 and had a year-over-year value increase and rent increase and rent income of total 9.5%. So this is what we assume for the next 10 years. Same with Joe. Joe had 100,000 and his net value is 100. It stays 100,000, and in the year-over-year increase, we will assume 11.5%. Now, as you can see, the Mike portfolio grows, and the second year actually topped or break even with $100 and almost $2,000, and then we see at year 10 he's at $210,000. So he more than doubled his investing into property, and he maybe live in it or maybe he rented. Same thing, I calculated 5% per year. So you can see all of this is considered. Now let's have a look on how Joe is doing. So Joe is actually already very much ahead. 11.5% he made in the first year, and you can see he doubled already in the 7th year, and he almost tripled in the 10th year. So you can see there's a difference of $90,000 between those two, and I can say that there is much less work to do for Joe, definitely, yeah. And there's some more, let's say, pro or cons when speaking about property investing versus stock market investing, which I just want to go into with you. So let's talk about emergency sales. So if you want to sell your property on emergency, you need the money, you need the funds, then you can surely attempt to go with the price 10 or 15% less that you actually want, which is very bad for your net assets. On the other hand side, stocks, in 1 second you can sell all your stocks and actually have exactly what they are worth, and most of the time, or let's say it's then depending on the market, if you at this moment has some gains or some losses. And there's definitely the factor of volatility. Now, volatility actually means that how volatile is, and I totally agree with you, the stock market can be totally crazy, and this is what mainly people are scared of. They say, hey, I can lose 20, 30, 40% of my value of my net investment, and this is true, yes, but if you go into indexes, even in the worst worldwide financial crisis in 2007, we lost 50% and then it went up again. So don't worry about it, and be a little bit more relaxed. If we're talking about loans, because loans is something that, if you're buying properties, most of the time it's with loans, but you have to be fair, because you could also buy stocks with loans and still had the better return of investment and the leverage investment. So actually, it's both the same, although loans can be a little bit more easier when secured with an asset like a property, obviously. Now, own time. Now, I can assure you that your time will be needed when you're going into a property. Now, because you are having all this notary and paperwork, and you have to take care about tenants, and you have to maintenance things, and it will take time, and that's for you have to account for this as well. Now, capital requirements, this is a negative for the property investment as well, because you definitely need more starting capital for property. I assume the minimum down payment for a property, depending on the property obviously, but I think like $10,000, $15,000, $5,000 is like minimum. And on the stock market, you can buy a share for even $1. And last but not least, obviously as a small disclaimer, I want to also mention that maybe some people will say, hey, you forgot a lot of things. I wanted just to simplify this. Maybe you have more taxes in your country, maybe less, maybe you have there more return, maybe there less. So especially property market is so different regionally, worldwide, that you cannot, separate it in a video, except you want to watch me for like 50, 60 minutes in a row, and I want to save you from that. So make sure to smash up the like button if you like this video. But these are very important points, because I didn't account, or I didn't want it to include, because it make all just more complicated, is you have to consider there's also inflation. Though inflation, the money gets less valued, it's the same for both. So actually it doesn't really matter in this opportunity. Then you have to obviously consider also for the loan cost or interest. Both are also the same, like property, as I mentioned earlier, are usually financed by a loan or a credit. So this is more into the property side. The rent income and the rent savings. So you have also to consider that, if you, let's say, invest into stocks and pay less rent than mortgage, then there's like a saving. So I didn't account it for that as well. On the other side, maybe you get a little bit more rent. So, I try to be as fair as possible. So you have to also consider that if you reinvest your capital or your rent into the property, this makes more interest. As more money you have, you're more percentage-wise I'm making every single year, which is the beauty of compound interest. The next point is also very important. If you sell after you lifted it or used it, or you won some gains on the stock market, you sell it, there's in most countries some sales tax or capital increase in tax. So obviously this I didn't account it yet, because I didn't sold it in this story, but you have seen, or you have to account for this obviously as well, that if you make some gains, if you make some profit, then you have to pay taxes on that as well. And last but not least, I want to mention it, but it's more into the property side, that lots of people are investing also in properties in renovation. So they actually put, let's say, $10,000, and that will increase the property price by $15,000. This is obviously very common into the property market investing, but for reasons that I didn't want to make it too complicated, I didn't want to put it in this calculation, because on the other hand side, you can also buy more stocks and gain more on the stocks as well. So I wanted to keep it as simple as possible. So see you tomorrow.